Hi, Mark Anderson here. I'm a mortgage banker with Paramount Bank. I'm licensed to lend in all 50 states, and I'd love the opportunity to earn your business. If you would like me to take a look at your purchase mortgage options or a refinance scenario, give me a call or shoot me a text at the number below any old time. Okay, I am bringing back the segment Answering the Internet. And what I'm going to be doing is in real time reading through an article in the mortgage news section. I just Googled mortgage in news. I took a look at some of the headlines, and we are going to read about rolling your closing costs into your mortgage loan should you do it. Now, the first thing I'm going to say before I even read word one of this article is I have a really hard time with any categorical answers to questions like this. I don't think it's as easy as saying yes or no. Again, I don't know what this author, Allie Yale with The Motley Fool, is going to say, but we're going to read through it. I'll provide some commentary along the way. So what we've got, many mortgage lenders offer what they call no closing cost loans. Mortgages you can roll your closing costs into rather than paying them up front. All right, I've already got a little bit of an issue with how this is being phrased. There's two ways you can achieve a no closing cost loan. One is real and one is not real. The real option is one that truly does not carry any closing costs. And this is achieved by giving you a higher rate than the lowest rate available in the market without discount points. So it might help to explain a little bit about discount points and lender credits. The way discount points work, as most people know, is if you pay more money up front in the form of discount points, you can use that to lower your interest rate. Well, there's a phenomenon, or rather something you can take advantage of that's the opposite. Let's say that the going rate for a scenario is 2.5% today. I'm just kind of making that number up for illustrative purposes. I'm not quoting a rate here. If the market rate's 2.5 for your scenario, you could pay maybe a couple $1,000s in points to bring that rate down to 2.375. But if you go the other way on the interest rate, you get a lender credit. So in this random scenario, 2.625, as that's above the market rate of 2.5, we're going to have the option of providing you a credit. Now that credit's going to depend on all sorts of things. It's going to depend on market pricing at that time. But the way you can achieve a true no closing cost loan is to bump up your rate to a level where the lender credit meets or exceeds the actual closing cost total. The other type of no closing cost loan that you often hear advertised annoyingly on the radio is one where there are fees, sometimes a lot of fees, and they say they're no closing costs because they're just going to roll that into your balance. So I just wanted to clarify that right up front. Okay, continuing on. After all, they reduce the amount of money you'll need up front to buy a property. They also free up cash flow, ensuring you have plenty of funds to finance any repair, rehab, or marketing costs on the tail end. But make no mistake, these mortgages aren't perfect. In fact, they could actually cost you more in the long run. Are you considering a no closing cost loan for your next investment purchase? Here's what you'll need to think about. Is it a short-term or a long-term investment? With no closing cost loans, upfront fees are really just rolled into the loan balance. True. Essentially, you're financing those costs. That means a higher monthly payment and more interest paid long-term. For these reasons, these types of loans heavily favor short-term homeowners, ones who expect to pay off the loan before those added interest costs really get out of hand. If you're planning to hold the property and the mortgage longer, it's probably not in your best interest to roll in those closing costs. Now, I've got a little bit of an issue with this. I can't say that this is 100% wrong. I know what they're trying to say. But trying to say that there is a right way and a wrong way on a question as far as whether you should take a no-cost loan, and in this way I'm referring to their definition of a loan where you're just rolling those costs into the loan balance. It's really hard, in fact impossible, for me to give any universal advice on this. I use this phrase all the time with my clients. You have to let the math do the talking. And there is a way, believe it or not, to calculate the numbers for long-term interest rate costs over time. You can do kind of an A-B comparison between the option where you're rolling costs in versus the option where you're not. And that math is going to tell an accurate picture, and you can quantify what the true difference is between the two. It's very, very hard for me to believe that you can say categorically that one is better than the other. I get what this author is saying, that in the short term, if you're only going to live in the property for a very brief period of time, that certainly lessens the blow of the additional interest rate costs over time. But again, I just resist the idea of being able to say categorically that one is better over the other. Continuing on, how much are the closing costs? You'll also need to factor in how much those closing costs are and what your monthly payment will be with them rolled in. If you're not careful, they could put you above your lender's loan-to-value or debt-to-income thresholds, which might mean paying for private mortgage insurance or, in some cases, getting stuck with a higher interest rate. Both of these equal extra costs and a slimmer profit margin to boot. Okay, I can't necessarily disagree with anything there. What's your cash flow situation? How much cash do you have? Not to mention how much you need should also play a role in your decision. Do you have the funds to cover the closing costs up front? Would doing so deplete your emergency savings or leave you lacking in funds needed for repairs? If so, rolling those costs in might be your only option. On the other hand, if you have plenty saved up or some equity you can pull on from another property, paying closing costs up front is likely your best bet. It might mean a bigger chunk of change now, but it will reduce your monthly payment and interest costs, ultimately freeing up more cash flow in the future. Another option. Instead of rolling your closing costs into your mortgage, you could also ask for lender credits, ding ding, or seller concessions. I'm going to pause here real quick. I'm happy that the author mentioned lender credits. I see that this term is most often not explained in any detail, to the point where most clients that I talk to, I don't know if I could say most, a lot of clients I talk to don't even know that the concept even exists, let alone how it actually works in terms of that scale of interest rates, discount points, market rate, and lender credits. So I'm glad that they're at least mentioning that in the article. Let's skip down a little bit. Oh, that's it. All right, I'm going to sum up my analysis of this article here just by mentioning a couple things. One thing that this really leaves out is a term in economics that I really like and I use probably 47 times a day, and that is the phrase opportunity costs. What it refers to is there is a cost that comes out of your pocket for closing costs. Let's just say it's $5,000. The cost up front is $5,000, but the opportunity cost refers to what you could have done with that money if you didn't write the $5,000 check. Now, one of the things I like about talking about opportunity costs is that there are definable opportunity costs. Like if you wanted to get really kind of pedantic about it, you could say, okay, either pay the closing costs out of pocket, $5,000, you write the check, or what if you took that $5,000 and you put it in an investment account? Well, the opportunity cost in that case is going to be quantifiable, because over time, if instead of writing that check, you did put that money in the market, you could do some projections and quantify over time what that $5,000 could earn you in the market. You could even use maybe a really conservative projected interest accumulation or dividend accumulation gain over time on that stock or that investment, and you could come up with some math. What I like about doing that, as pedantic in some ways as the example might be, is that you can have basically two sets of numbers to really compare at that point. Yes, you can do the comparison of what's your payment without rolling the closing costs in versus rolling the closing costs in. But I like to do that calculation with this opportunity cost element factored in, because I think it's really interesting and important to see, okay, what's your net outcome if you factor in that $5,000 going into an investment account? Again, I'm not saying that this is going to be for everybody. There are some of my clients that really like that approach and want to get really into the nitty-gritty with the numbers. But in addition to the quantifiable opportunity costs associated with writing that $5,000 check instead of doing something else, and this article does mention this, I mean, there's all kinds of things that you may want to do with that money. Any number of things that you might want to save for, whether it's emergencies or just to have on hand just in case. There's value in that. The value in having that money on some basic level is not really something that you can quantify. It ends up being a subjective judgment call on your part as far as how much that $5,000 means to you. I would say in general, just to sum up on this topic, yes, there's a lot of math that you can run. I am hesitant to say that one option is better than another option. I think every scenario for every client, we need to really drill down and talk about these options. I want you to have all of the information so that you can make an informed decision. But I kind of, as much as I focus on math, I also try to get people thinking about the bigger picture. Any mortgage decision, although it includes all sorts of financial aspects, there are non-financial aspects at play, and there are all sorts of things that I think that you should consider with a decision like, do you roll the costs into the loan or do you not roll the costs into the loan? So I'm going to continue to do more of these Answering the Internet episodes. I hope you got something out of watching this video. Please do like the video, subscribe to my channel for more content coming your way on a regular basis. Thank you so much for watching. Thanks.